gotta leave your money behind you. Raise your hand to...
Hello, everyone, and welcome to Give Me Some Truth International Edition, also known as Dis-moi la verdade in some parts of the world, I believe, and Dis-moi la vérité in others. I'm joined today by Stan Farmer, and what we wanted to do is give our viewers a very quick update on markets and what's been happening in global markets since the beginning of the year. And, you know, this is kind of a halfway point summary of the action of what we've seen in markets. You know, we're getting to the middle of June, and, you know, surprisingly, it's been a positive start to the year. And I say surprisingly because, you know, if you think back to where we were in January, and you and I were talking about this just a few minutes ago, the mood was very different, right? So if you think about where we were in the beginning of the year, I mean, Stan, everybody was negative.
We were building the wall of worry that makes markets climb, right?
The wall of worries, right? And I think that's interesting, and that's actually something that I wrote about in my 2023 outlook, which was titled "A Bear Market in Search of a Recession," and that's really what it was. Is we had a rough patch in markets, and everybody was talking about recession. And you could see the bearishness in a number of data points, including fund manager surveys, including positioning in derivatives markets and things of that nature. And at the time, I highlighted that, you know, that negativity in itself was a risk, in the sense that it wasn't necessarily it may have been overdone. And it failed to account for, you know, a number of very positive factors, including the strength of the labor market here in the U.S. and in many other parts of the world, and also the fact that, you know, things like inflation was slowing down a little bit, and there were hints that, you know, the Federal Reserve may start to change course. So, you know, what we've seen so far this year has been really generally positive.
Sure. Well, I mean, when you think about it, Syl, I mean, one of the death knells of the great bull market that ran post Great Recession was this confluence of events. The Federal Reserve having to shift post-COVID, you know, helicopter money into a less accommodative policy because of inflation, right?
Right.
And then you had Vladimir Putin march his troops into the Ukraine at almost the same time that inflation was really starting to heat up, which, of course, is putting kerosene on the fire of inflation. And, you know, now after a series of unprecedented super hikes, right? We found ourselves back in a more normalized short-term interest rate environment where there were at least nominally, short-term rates were back 4 or 5%, right? So I think over the beginning of this year, people started to realize that, well, if the Fed isn't done, you know, which inning are we in? That's the old baseball analogy that they love to do here in America, right? Are we in the 7th inning? Are we in the 8th? And so there just seemed to be a shift of understanding that, you know, we were probably through the worst of Fed tightening,
right?
If not like a pause, and we're still right now kind of in the waiting stages to see. We've heard from Fed governors that are suggesting the Fed might be willing to wait now because hikes have a lagging effect, right?
Right.
We don't know until later whether or not they've they've had the intended effect on inflation.
Right.
Right. But the inflationary numbers have been a little better. Right. And we haven't gotten that recession that the market was in search of.
Exactly. And, just to clarify some of my views as well, I mean, I'm not saying there is no risk of a recession in the coming months or the coming years. But, I think if you look at the shape of the yield curve, which is still deeply inverted, I think you can't ignore that sign. At the same
Glad
time,
you brought that up, because that's something that doesn't get brought up enough. It's been with us for quite some time.
It's been with us for a long time, and it's meaningful. This is not a sign that I'm prepared to say you can just ignore it. At the same time, just because there are signs that we could run the risk of a recession in the short or medium term, doesn't mean that every time someone screams recession that they're right.
Right.
And I think there was a lot of that happening at the end of last year and early this year, where a lot of people were betting against the market and were putting on that recession trade. And as time went on, they were proven wrong. And that's been an interesting development, I think, so far this year. At the same time, one thing that you and I have been discussing a lot as well is just the fact that even though indices have done well and the S&P 500 is up for the year, and so are most of the main European indices, there's not been a lot of breadth to this rally. Right? It's not really been a very broad rally, and it's really been concentrated around really just a few stocks and maybe one sector, really, as far at least in the U.S.
And that sector would be the story repeats.
Story repeats. Technology mainly.
Right. Well, I mean, it's done the best, right?
Mm-hmm.
But it did the worst in the bear market that we
Right.
that we're trying to come out of.
Mm-hmm.
Right.
Absolutely.
So part of that
is just a rebound story, right? It's just the stocks that were hit the hardest in 2022 staging a comeback.
Just reverse gravity.
Reverse gravity.
What goes up must come down, and they did hard. But in a rebound, things that have lost the most are also likely to be the things that, at least in the short term, bounce the highest back, right?
And I think that's a big part of the story. Another component, I think, is the fact that these are the same sectors that really benefit from the sort of lower interest rate, easier monetary policy environment.
Yeah.
And we've seen that in the QE era, really, in that entire period of time between 2012 and 2020. It was also led by the tech sector, and
Right.
multiples were expanding. And that was the story. And we're seeing a little bit of a return of that trade, right? So it's kind of like the tech trade of the glory days of QE is back. And that tells me that the market is also responding to this perception that the Federal Reserve is done.
Yeah.
And that they're going to have a softer stance, a softer policy stance going forward. And I think I think June will be the first Fed meeting where they are going to officially pause interest rate increases and maybe start.
That's the expectation.
That's the expectation. And
so the risk here could be
a disappointment on that front.
Yeah.
And as always, the market is and people are going to dissect every word in the corresponding press releases. And I think they're going to look for very explicit language, making it official, so to speak, that they intend to pause for the time being, right?
I mean, this is really fascinating to me, Syl, because we you led off here talking about how the recessionary evidence of recession or a pending recession really hasn't been borne out in the labor market, which has remained somewhat resilient, right?
Mm-hmm.
On the other hand, which company, like what's a common factor amongst all these tech companies that are rebounding so well? To me, seems to be that they're the companies that have made headlines this year thus
Yep.
far by laying people off.
They've laid off a lot of people.
Alphabet, Meta, Amazon, Microsoft,
Yeah.
every one of them, right?
But they were so grossly overstaffed, though, to start
Exactly.
with. I mean,
They took the helicopter money and they I mean, stories out there are that they hired people to keep those people from going to work for their competitors, but they had no actual job for them to fulfill.
yeah, it's like I read headlines about, this tech company laid off 5,000 people. I'm like, how did they have 5,000 people in the first place? It's like you're running a website and an app. Do you
That's
really need
also
that
true,
many
yes.
people?
So maybe in a perverse way, investors in some of these companies could be excited by the fact that economic rationality is returning to the boardroom. Maybe
That could be part of the story. Absolutely. And I do think that in terms of the breadth of this rally, and it's been kind of a weird market because there's such a disconnect between the tech sector and really the dividend paying, more value oriented kind of areas of the market, that even though it's been a good year for markets overall, like value sectors have actually been down. Like you lose money this year by just not being.
It's been tough for energy, right?
It's been tough. So energy is one of them, but
and then we had the financial sector. Obviously, we had
there was a story
the
in the
headline
financial sector.
bank failures,
Mhm.
right?
Right.
Those actually happened, right? So I mean, like it wasn't just a fear of something happening,
Of course.
but oddly enough, that whole avalanche was caused by a snowball called Silicon Valley Investment Bank, right? It was caused by the weakness in the private equity component of the tech sector, more than anything.
Yeah, that and higher interest rates that were poorly managed, but yes, it was
right.
Yeah,
But like a lot of borrowing from companies that got ridiculous valuations in 19 and 20, right?
Absolutely.
So it seems like full circle, like the tech has been able to come back, but it kind of like threw a wrench into the financials machine, and caused a lot of people to freak out.
Right. And so as we wrap up here, I'd like to think a little bit about some of the risks going forward. I mean,
Sure.
I've been fairly constructive about risk assets and about equities in general since the
What
beginning
about
of the year.
international?
Internationals, it's been a little bit part of the story as well, in the sense that Europe has performed just as well as the US, maybe slightly outperformed even in the last few months. And, that's kind of a rare event in and of itself. So it's been good to see value doing well there. And I think that could continue to be part of the opportunity going forward. I do think that part of the opportunity here is, a broadening of the rally to start to capture other sectors and capture maybe more international names and maybe small cap names and maybe higher dividend payers and
we saw small caps really underperform as tech soared, but like recently it seems like the Russells had some leadership days, so perhaps we're getting some of that broadening, perhaps.
So I think that's the opportunity. In terms of risks, the one risk that I'm very, very focused on is the possibility that the Federal Reserve could embark in a new phase of tightening. I don't think that's a risk that the market is fully appreciating. I think it wouldn't take much for them to do that. It would just take a few hot inflation prints. And I think if we do start to see a shift in sentiments, if we see a broadening of the rally, if we see companies starting to hire again, that's a very real risk. And that's something that I'm watching very, very closely.
When Syl talks the Fed, Syl talks the Fed because he realizes just how much that tail wags the dog, and the dog being the market and the broader market, right?
Absolutely.
Interest rates are everything, so I totally agree that that we're not we're not necessarily out of the woods with the Fed. Getting the governors to suggest that they might start a tightening, a pause phase is very different from a shift in, to accommodation, for example, right? And it's also, it leaves the door wide open to, we're going to be data dependent.
Data dependent.
Data dependent is a big Fed word for we're not sure what's going to happen, but we're going to react to it, right?
Absolutely. Absolutely. I think that sums it up really well. All right. So we're going to wrap it up here. Thank you all for watching and listening to another episode of Give Me Some Truth International.
Yes, thank you very much.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.